Welcome back to Small Caps, ladies and gentlemen. My name, Kerry Stevenson, and I'm delighted today to be speaking with Peter Krauth. Peter is the editor of Silver Stock Investor and author of The Great Silver Bull. And the reason I've asked him on today is The Great Silver Bull is a book that I want you all to go out and buy. It's on Amazon, so very easy to find. And the reason I want you to do it is because it is in one book. You will fully understand not only the history of silver, where it's going, and I guess a little bit of the history of money. But rather than me tell you all about it, Peter, great to see you. Welcome to Small Caps, and thanks for your time.
Well, Kerry, thank you so much. I look forward to our chat.
Well, before we get into it, this is the first time you and I have spoken on Small Caps. Give our community, our listeners, a little bit of background as to who you are and why you wrote this book, The Great Silver Bull.
So I have actually been researching and writing about commodities and precious metals in particular, going back over 15 years, investing in this sector for over 20 years. And in 2020, I saw what happened with silver. Silver and gold were obviously standout performers in the COVID pandemic panic. Gold was actually up 40% from its low, and silver was up 150% from its low hit in March of 2020 until about August. So in the space of about 5 months. And when I saw that kind of reaction in both metals, and silver in particular outperforming gold almost on a 4-to-1 basis, for me, it said that this is the trigger of the acceleration phase in this secular precious metals bull market. And I need to do something about it. One thing was to start a newsletter, the Silver Stock Investor, which was launched last year in January. And it's gotten a great response. And 2 months later, I decided with a friend who I used to work with, kept telling me, Peter, you need to write a book. And, now you've started this newsletter and you really know silver intimately. Why don't you just write a book on silver? And I thought about it, and not for very long, because I realized that I had accumulated a lot of research and feedback and analysis on silver. And I said, we're in the middle of a pandemic. This was March of 2021.
Yeah.
And why let a pandemic go to waste, right? There's not a lot of social time.
You can't do anything, so might as well write a book.
Exactly. So I said, you know what? It's now, it may be never if it's not now. So I buckled down and I got started. And I said nothing to practically anyone for about 6 months. And then I brought it up, and then it just kept rolling and rolling. And by sort of early this year was mostly done, and then sort of had to put the finishing touches on it in the last few months. And it was published at the start of May this year.
Yeah, so that's why I wanted to bring you on, because quite frankly, right now, Peter, no one cares about silver. No one cares about gold. And in fact, precious metals as a whole is on the nose, if you like. And even today, Rick Rule recently said to me, take a step back and look at the bigger picture. Gold and silver have done what they've always done, which has held their purchasing power. But you focus more on silver, and you've said, and I quote, that you think that silver could get to $300. Now, I know there's people out there right now throwing tomatoes at the screen and saying, you're crazy.
Absolutely.
So I want to know the thesis behind that. And, hindsight is 2020, but looking into the future is much more difficult. How did you get to even coming close to a $300 silver?
The way I got to $300 for silver as an ultimate peak, and so let's be fair, I'm talking about, under the conditions that are like a speculative mania. No, I'm not saying it's going to 300 and it's staying there. I'm saying that similar to where silver peaked at $50 in 1980, you could get this blow off top where it reaches 300. And as I say, again, ultimately wouldn't stay there long, would sell off, but it's the kind of peak that we could potentially see. And so how I get there is through multiple indicators. One of the main ones is the gold silver ratio, which your listeners may be familiar with. And that's very simply the price of gold divided by the price of silver, which tells you how many silver ounces it takes to buy an ounce of gold. And that ratio varies over time. Right now, we're close to, I believe it's 85 or 90 ounces of silver. And that has averaged about 55 to 60 ounces of silver to buy one gold ounce over the last, say, 20 or 30 years. But in the 1970s, when we have a good analog, which was the last bull market for silver and gold. And by the way, silver returned about 3,700% in that bull market, and gold returned about 1,400% in the 1970s. So silver more than 2-for-1 outperformed gold. Silver went from about $1.30 to $50 from 1971 to 1980. So to get back to the ratio, in 1980, when silver peaked at $50, the ratio dropped to an ultimate low of 15. So it took only at $50, it took just 15 ounces of silver to buy 1 ounce of gold. And that ratio at that point was very much out of whack. It was very far from its mean, from its average, and was by all likeliness, due to bounce back and go higher. And so it did. Silver prices fell, gold prices also fell, but silver prices fell more rapidly percentage-wise, and things went back to normal. So if we use that as a comparison for today, I look at forecasts, what I think are reasonable forecasts for the gold price in the ratio. So we have people like Jim Rickards that your viewers might know, people like Shane McGuire, who ran a gold fund for the Texas teachers retirement system. We have people like Scott Minard, who is a chief investment officer for Oppenheimer, and I believe he's some sort of advisor to, I believe it's the New York Fed. So these are people that are highly regarded. And in fact, one more, the people who write the In Gold We Trust report, which is part of Momentum, right? Ronnie Stoferle and Mark Valek.
Ronnie. Yep.
Absolutely. They do a tremendous job. And I quote many of their charts in my book because I think that they just do such amazing work. And so in some cases, we have a forecast by these respected analysts of anywhere from $5,000 to $10,000 gold, ultimately. And I've been saying publicly since back 2009, 2010, that I think gold will easily reach 5,000. We were not long ago at 2,000 when in March, when Russia invaded Ukraine. We were at 2,000 in August of 2020 when the pandemic panic hit. And so, from a level of 2,000, $5,000 is 2.5 times. I feel that's not unreasonable. I feel that we are still in a very long secular bull market for precious metals. The effects of inflation have yet to really fully be appreciated. Yeah. And so let's say gold goes to 5,000 and we reach a similar low in the ratio of 15. So if you divide 5,000 by 15, that's $333 silver. I round down to 300, and that's one way I got to 300.
Got it. But it's interesting, Peter, because you talked about the 1970s, and you just mentioned then that, inflation is here, but people they're kind of talking about it, but mainstream media is not really talking. I mean, they kind of mention it briefly, but it's not becoming what it was like in the 70s, because at the end of the 70s, we had inflation at 14%, we had mortgages at 18%, and Fed rates at 20%. Now, those numbers sound to me like that's what we're coming back into now, and everything's cyclical. And as you said at the time, back then, we had a secular bull market, and that's when things got pretty interesting for precious metals. Are we having a repeat of that moment in time? Because inflation, mortgages, Fed rates all seem to be on the rise?
So my answer to that is going to be history rhymes, but doesn't necessarily repeat. And so the big reason I say that, and I've used this chart, I believe, once or twice in the book, and I look at the US debt to GDP ratio, and I go back to 1970. And in the 70s, the debt to GDP in the US was actually trailing downwards, which is really hard to believe that in that period, debt actually went down relative to GDP. And it ended the 70s, so around 1980, at around 30% US debt to GDP. Today, we're at about 130%. So, for me, what that means is that we are in a similar period, meaning inflation is going to run. Interestingly, and I do talk about this in the book, and I provide a chart that shows how inflation behaved in the 70s, and it wasn't a constant straight line up. It was actually a series of waves. So we had 3 waves of higher inflation. So, and the reason for that was because the Fed would try and step in, raise rates like they're doing now. Inflation would back off. It would not drop to the previous low. It would drop to maybe half of the previous of that bottom to top run, and then it would start to rise again. That's because the Fed and other central banks start to back off when they see recession, which everyone's starting to talk about right now. So that might be as little as 6 to 9 months away when the Fed will start to say, oh my goodness, there's recession. People are panicking. Home sales are starting to slow down dramatically. Unemployment's starting to rise considerably. We need to perhaps not just stop raising rates, start backing off. They've got very little room to maneuver because right now rates are at 1.5 to 1.75. They might go to 2 to 2.5, somewhere in that range. That's not very high. And that's if they get that far, perhaps slightly higher. Anything's possible, but I seriously doubt that we're going to get anything meaningfully beyond 3%. And they'd need ultimately to have rates high enough to start cutting them back. And so from 3%, there's not much cutting that you can do if you get into a recession. So their hands really are tied. If we go back to what I was saying in the 70s, we had these 3 waves of inflation. Inflation ran up, corrected. As I say, the Fed stepped in, raised rates, backed off. Inflation kicked back in again. Fed stepped in again, raised rates, then again, eventually backed off with recession. And then you had this 3rd wave when inflation just went absolutely crazy, up to 14%, which if you think about, and things were calculated differently, so they actually were much more realistic inflation rates back then. We're only at half that right now. So we've got, if there is a repeat, we've got a long way to go. But ultimately, the Fed under Volcker in the US was able to raise rates up to 20%, which absolutely sounds astronomical right now, because the debt to GDP level was so much lower. In other words, not just government. So government debt was a quarter of what it is right now versus the size of the economy, but homeowner debt, mortgages were much less burdensome. Student debt, car loans, consumer loans, all of these things were much, much less inflated than they are today. And so people could handle, and governments and business could handle much higher rates, even if it was just for a short period of time to break the back of inflation. Today, I believe that's completely impossible. There's absolutely no way that central banks can raise rates sufficiently to break inflation's back. And I think so what will happen is that they will continue to talk tough, and it will have some limited effect. They will raise rates as much as they can, knowing full well that inflation is running much higher than where they're able to go. And frankly, they will let inflation run, because it becomes a choice between raising rates enough, which they realistically can't do because debt levels are so high. And even if they, let's say they did, and they were to break the back of inflation, they would absolutely crush the economy. And so they know that, and they also know that they're truly servants of the government. Let's not kid ourselves. And on that basis, the government, with a $30 trillion debt in the US at 3%, imagine that they were paying 3% on that debt. That's $900 billion a year. That's nearly $1 trillion in interest alone. The budget is already.
And how do they do that? They've got to raise rates. And you know what? You just mentioned the Fed, Peter, and I want to bring this up because it's important people realize the Fed is actually a private institution. Private.
That's right.
So who pays the Fed? So, Peter, who pays the Fed?
Well, there's a lot we don't know, in fact. What we do know is there are over 400 PhD economists working at the Fed. We know that there are 23,000 employees at the Fed, which sounds like a city to me in terms of population. And the Fed we actually do not know who owns the Fed. It's a spread ownership across the main banks, the larger U.S. banks, and so there are apparently no clear guidelines on exactly who owns the Fed in what capacity, et cetera. And so it's absolutely ridiculous to think that such an institution that decides on the price of money and has so much power has to be so veiled. It's just incredible that this is how our economy is. The strings are being pulled on our economy. It's amazing that we've gotten to this point. It really is.
It's pretty scary, quite frankly. And there's another book out there called The Creature from Jekyll Island, which actually talks about the Fed and shows what it's all about, which is fascinating. And I always say to people, read books. Like, if you want to understand silver and also what's the history of silver and why actually silver matters, then go get Peter's book, because that will give you a really big and fuller understanding. Because I think very few people understand why silver even matters. And you've got that as part 2 in your book, Why Silver Matters. Because I want to ask you this question, Peter, for a specific reason, and that is this. Why do we even care about this, as some people put it, barbarous relic? Because today everything is going digital. We have Bitcoin, nice and easy to, and I know Bitcoin's very volatile, but governments are also going into a digital style currency. And it's what people know. It's what people, the tap and go mentality these days. People don't even hold cash. So why would they even bother with gold or silver, precious metals, when they can just tap away?
You're right. Absolutely. The one thing, I guess the one caution I would give, as a bit of a disclaimer and right off the bat, is that people have to be careful not to look at the recent past and assume it's an indication of the nearer term future, potentially. It's recency bias, and that's very dangerous. If you look, my money is on history, 2, 3, 4, 5,000 years of history. Silver is the most used asset as money throughout history. More transactions over time have taken place through silver. And silver, an interesting thing about silver is that it is both, compared to any other metal, it is both money and an industrial metal. Half of silver is used for industrial purposes, and the other half of silver is some sort of investment or decoration or jewelry, which you could argue in many ways is a form of savings and therefore a form of investment. So I, in a broad way, split it half between investment and industry. And you're right about digital currencies. I absolutely believe that national currencies are going the route of digital. It seems inevitable to me. And because of that, I also believe that it's going to accelerate the end of the kind of system that we're in now, because it'll accelerate inflation. Right now, although it's true that less and less physical paper money is being used, to be able to simply through a few keystrokes add to someone's account, debit from someone's account, right? And to control how, I'll give you an example, and I talk about that in the book. There was a directive from the Central Bank of England to members of Parliament that when they decide what their digital currency should look like, that they should ensure that it's programmable. Now, to me, that makes my skin crawl.
Wow.
Absolutely. So, you can project anything you want onto that. That could mean, does that mean that a certain person's digital currency can be blocked? Does it mean that an owner of a digital currency, because they're in a certain postal code or zip code, can only be used at certain places for a certain amount of time? Can you make it so that that currency will expire if it's not used before a certain amount of time? The possibilities are endless. It's a wet dream of a central banker, frankly.
Yeah, but you know what? But Peter, again, people out there will be going, crazy times, never going to happen. But in my opinion, never a truer word said, because as you said, if they turn around and say, make it programmable, and if you think we're all conspiracy theorists and you think we're crazy, that's fine, ladies and gentlemen, go to the next video. However, I think Peter is talking about something which is closer than we think. But what I want to know is then where do precious metals sit within that? Because right now, no one cares.
You're right. And we do right now that's a very good point. Consider that gold is actually flat on the year as we speak. Silver is down about 11 to 12%, I believe, roughly since the start of the year. But 20-year bonds in the US are down over 20%. The S&P is down 20%. The NASDAQ is down about 30%, while oil, for example, is up 40% and the dollar is up 10%. So there has been, if you look at oil and the dollar and gold being flat, there has been a flock to safe havens. The paper assets and even real estate, frankly, is down by some measures by about 15 to perhaps 20% in some markets, et cetera. You have to look at that and realize that there has been a run to some traditional safe havens. And so gold being flat is really, there's this saying that, in this kind of environment, he who loses the least wins. Yeah. Well, if you look at gold at being flat over the last 6 months, and even silver being down maybe only 11 to 12% over the last 6 months, on a relative basis, that's actually quite good. And I'd like to actually refer to a chart in the book because it actually shocked me when I did the research and came across it. And so I thought to myself, I'm going to see how gold and silver and stocks the broader indices have performed since 2000. And so it's changed a little bit in the last couple of months for sure, but proportionally not all that much, perhaps even in the favor of precious metals. But I'm willing to bet if you ask the average investor going back to 2000 to, let's say, May of 2022 when the book came out, yep. Where was the best place to put your money? And I think almost invariably, the answer will be stocks.
Or real estate.
Or real estate, that's true. I didn't compare real estate. However, I did compare the S&P and the Dow with gold and silver. And it will shock most people to know that although the S&P and the Dow are up about 200%, And that includes the financial crisis. It includes, the period after 2000 where we had an extended correction and so on. Stocks were still up over 200%, but silver was up nearly 400%, and gold was up nearly 600%. And that's since 2000. Okay. I mean, dramatically outperforming stocks. Yeah. Gold on a 3-to-1 basis, silver on a 2-to-1 basis. And as I say, I totally believe that we're in a long-term secular bull market for precious metals. Silver and gold are much higher than where they started in 2000. They have a long way to go. And so, to see them at the levels that we talked about earlier, I think is basically baked in. People are very, very much, gold and silver are very much under-owned. And they've proven themselves over thousands of years as being safe havens in exactly this kind of environment. I really don't see why this time should be different. And I'll give you another interesting factoid. Back in in March, when it was in May, after Russia walked into Ukraine, and we saw gold spike. In the month or two after that, the two largest gold-backed cryptocurrencies, because you do have physically backed cryptos, there are cryptos of all types, cryptocurrencies. Yeah. The two largest gold-backed cryptos, if you added their market caps together, reached $1 billion. So that said a lot to me. It said that, one, you had people who were interested in gold in some form, right, and had saw what was happening with gold at that point in time, and said, "Okay, there's dramatic inflation. There's a war that has just started. We're having massive supply chain issues." So they wanted exposure to gold, and they also looked at, okay, so do I really want to go out and buy some gold? Am I going to store this? What am I going to do with the gold? I'm comfortable with crypto. I'm comfortable with, some version of gold or of a crypto that is backed by gold. That's something I'm willing to invest in. And so, it's obviously a certain kind of investor profile and so on, but to get the two largest gold-backed cryptos to reach a combined market cap of $1 billion really is quite an accomplishment. And so it's because you had investors that were comfortable with that form of gold, and they said, yes, this is how I'm willing to invest in it. And so I believe that's the mix that we're ultimately going towards. If you ask me what's the ultimate form of money, I believe that you cannot deny the advantages of crypto. Obviously, we're going to have to work out all sorts of things, but the blockchain has tremendous advantages. There are all sorts of ways that crypto is superior in the sense of nearly frictionless, meaning very low transaction costs, the speed of transactions, the security of transactions through blockchain. And so if you actually had a widespread use of precious metals backed crypto, safely backed, in that case, I believe you would have the best kind of money that we could possibly have.
Well, let's see whether I totally agree with you. Because especially that sort of younger generation, which is so used to that digital environment, they don't want to go and put a kilo of gold into a vault and have to go and pet it every now and again when they've lost their keys and they don't know how to get into the vault, and they certainly don't drive cars to get to the vault anyway.
That's true.
We're running out of time. I want to ask you a couple of things. The first one is a quote from you which says, "Global financial reset will lead to the biggest transfer of wealth in history." I'll repeat it. "The global financial reset will lead to the biggest transfer of wealth in history." What do you mean by that? Do you mean that people are going to go out of, real estate? Like, what Where's that coming from?
So that actually leads back to the last topic, being that precious metals will regain their place in portfolios. Right now in the US, we'll use that as an example. If you look across the board, the average ownership of gold and silver miners and gold miners is less than 0.5%.
Yeah.
If you look back at over, say, 20, 30, 40 years, the average, or sorry, in the 1970s, that actually went up to about 1.5 to 2%. So just to get the kind of return to the mean of, and we're in the kind of environment where we're more than likely to lead to that kind of, market action. Gold and silver need to double, triple ownership in terms of, as I say, the physical and the miners, to get the kind of replay of the 70s. And we are in that environment. And so that's where the transfer is, and that's where the transfer takes place. You're going to have, we're at the start of it. I've been saying since the start of the year that the 60-40 portfolio of, 60 stocks, 40 bonds, that I believe is dead. Even if stocks go through, some phases of, bear market rallies and then corrections and so on, bonds in all likeliness are at the end of of an incredibly out of the ordinary long-term bull market, a 40-year bull market, which is crazy in bonds. We're absolutely very likely at the end of that, with rates going up and bonds being down 20%. How many investors are opening their investment statements, and looking at them and saying, what is this? 20% down in my bonds? Exactly. Bonds are supposed to zig when stocks zag, and they didn't. They were both down in the first quarter and the first 2 quarters of this year. People are starting to be shocked by what's happening. They're starting to wake up. I think they really are realizing. And the kind of response I've gotten about the book is that, and in fact, even from some younger people who said, your timing is actually pretty good. With what's happening in stocks and bonds, people are starting to look at alternatives. And I was actually surprised when someone like 25-year-old said this to me. But these are people who are well-read, relatively well-read and open-minded, and are starting to look at these kinds of things and are saying, stocks and bonds are not performing. Crypto right now, at least in many ways, is not performing. What is doing well? And frankly, until at least perhaps a couple of weeks ago, silver was nearly flat on the year. Gold was actually up on the year. And as we said earlier, on a relative basis, precious metals have outperformed. And so people with open minds and willing to look are seeing that this is a space that is performing. As you said, I don't know if that was before we started the chat, to record the chat or not, but that, Rick Rule said, you've got to look on longer term basis. And if you look at silver, for example, exactly, step back. I always say zoom out to get a real perspective on what's going on. And the last, say, 3.5 years, silver was actually up 35% from late 2018, which is actually very good, on a multi-year basis. Silver was just, going sideways until sort of the earlier part of 2018, went from $14, $15 to $18, $19, corrected on a very short-term basis in 2020, spiked to $30, went sideways, and now we're just below the bottom of that range. I believe that in all likeliness, if there is more downside in silver, perhaps we could reach 17 on an extreme, $17, $18. That's the all-in cost to produce an ounce of silver. If it makes it there, I don't see it staying there for long, because there's no profit anything lower, in fact. So it's likely to bounce, and I believe that we're going to end the year considerably higher. People should really hold on to their hats, and if they want to make money, the old adage of buy buy low and sell high, buy things that are cheap. Silver is more than 50% below its nominal all-time high, and it's more than 90% below its inflation-adjusted all-time high, which was from February 1970. Nearly all metals, base metals, platinum group metals, specialty metals, gold, practically all of them, I mean, all of the major metals are at least 30 to 50%, and in some cases, thousands of percents above those highs. Silver is the only one that is well below those highs. If you want a bargain and you want something that's proven itself over history, silver is the place to go. And yes, it's volatile. I talk about in the book how to deal with volatility, but the potential is really, you have a generational opportunity ahead of you.
And I think it is important. We're running out of time, so I'm going to leave the last note to you. But in part 5 of the book, Peter talks about how to invest in silver, the different ways to invest in silver as well. So this is a very well-rounded book, ladies and gentlemen, because it's all about the history, why silver matters, why it's irreplaceable, why it's unique and set to soar, and finally, investing in silver. So it's a very well-rounded book. And I do encourage you all to go to Amazon and buy it. And I'd also like you to go to Silver Investor. I think it's silverstockinvestor.com, where you can read more about what Peter is doing. But for now, Peter, the last word goes to you. What advice would you give to people in a brief summary of what we just spoke about?
So I would say, keep your mind open. Be careful of what I mentioned earlier, recency bias. You know, you've got people like Ray Dalio, just some tremendously successful investors who are saying, just because things have been a certain way for the last years, decades even, do not assume that will continue. You really have to consider, where are we headed? Where are all of the signs pointing? And I've said for the last, I'm going to say probably year or so, that inflation is likely to be the determining factor. It's going to be the most influential factor in the investment landscape going forward, probably for at least the next decade. And if you look at what has performed during inflationary times, and remember, this is going to be, you know, gold and silver did well in the 70s, and that was despite interest rates being dragged up by central banks because they could. They can't do that this time. We've talked about that, and I explained in the book why they can't. So imagine in a scenario where they can't raise rates sufficiently because debts are too high. Inflation will absolutely run rampant. Yep. And because of that, look at what has performed. These are your absolute go-tos. And silver, you know, as I've said, outperforms gold in bull markets. It is more volatile. You can adjust for that through position sizing, et cetera, et cetera. And I go into all of that in the book, but you really absolutely, even, you know, the most conservative investor will want some silver in their portfolio.
Yeah, it's all about making sure that you are diversified in these crazy times that we're following ourselves in. As always, ladies and gentlemen, do your own research. But Peter Krauth, silverstockinvestor.com. Thanks so much for joining me on Small Caps today.
It's been a pleasure, Carrie, and I certainly look forward to the next time.